Good morning, everyone, and welcome to the Prosperity Through Multifamily Real Estate Investing podcast. As always, I'm your host, Real Estate Cody, and joining me, as always, for another great episode, Mr. Brian Alfaro. Brian, good morning to you, my friend.
Cody, good morning. Excited to be here this morning.
Me as well. Me as well, man. We really had a lot of great things going on. Been meeting a lot of great people the past couple of weeks. Always love networking, and so always a great way to spend the week meeting with other people in the space. But really excited about our potential guest today and to talk about some unique strategies in the multifamily space. So, who are we talking to today?
All right, today we've got Mr. Michael Parks from Spire Investments. So we have Michael's mission is to help busy professionals achieve financial security for themselves and their families, taking away the frustrations and fears that come with relying on their jobs or Wall Street for money. Michael is a real estate investor, technology leader, and has worked for REITs, managing $30 billion in hotels, commercial office, logistics, and senior living assets. His primary focus is on acquiring and repositioning multifamily communities through his company, Spire Investment Properties. Michael, welcome to the show.
Hey, thank you. Glad to be here, guys.
Yeah, we're excited to have you.
Thank you.
Absolutely. Yeah, definitely excited to have you here, Michael, and always interested to learn about others' journeys into the commercial real estate space. So why don't you tell us a little bit more about your background?
Yeah, sure. So I think I probably took a pretty long and winding road to get here, but it's been a fun and interesting journey. You know, I started off doing vacation rentals, and I think like a lot of people, when I was younger, I said, geez, wouldn't it be great to have a vacation home and I could just rent it out and have it pay for itself and then still be able to use it when I wanted to. And so I went ahead and did that, and I bought a ski house up in New Hampshire. I'm in New England area, and I bought a ski house and I rented it out, and it didn't quite pay for itself, but I did use it a lot because what I found is I really like skiing at the ski house, and the renting part was a lot less fun when it was my house because I'd show up and never know what type of stuff was broken or what I was going to walk into. So I did do that for about 10 years. And then I decided to just make it, a second home. And then I did sell it, and I sold it profitably. The real estate market did well over the 17 or 18 years I owned it. But I said, there's got to be a better way here. And I think like a lot of people, I was looking for passive income. And so I went down the path of building passive income through some hair salons that I opened, and then ultimately apartment rentals, limited partnerships, and now I'm moving into the GP space.
Quite the background there, man. That's interesting. I don't think we've ever talked to somebody about hair salons, and that's an area in my life where I could use a little help right now because it's kind of fading a little bit there. So,
Cody, and I think it's important to highlight too, and Michael can probably shed some light on this. Vacation rentals are very attractive, and people seem to have the easy thought process of, I like going on vacation. I'll just get another home and rent it out when I'm not there. But it's probably not as easy as it sounds, is it, Michael?
Yeah, well, you know what? It's not that it's particularly hard. It's that you got to get vacation rentals in the right market and to keep them full. And so, a lot of them are more seasonal. You have off seasons. So vacancy is, you need to factor that in for sure. But I think the big thing for me was that if you're going to buy a vacation rental as an investment, you need to run the numbers like it's an investment, and not look at it as, well, I would like to go there and now I'm going to go there and not have to pay for it. Because as soon as you're into that mode, it tends to work out that the numbers don't work out as well for you. And it's probably not the best investment. And so I've switched over and started saying, well, let me make some great investments. Let me get income that I can then go use to do vacation wherever I want to vacation, and not have to go to the same house that I've already invested in and feel like, okay, I need to keep going there over and over again. In my case, it was skiing. So I skied one mountain for 17 years, essentially, because that's where my house was, right? But now that I've sold it, I'm free. I can go anywhere and ski, and it's a lot of fun. So, that was my experience with it. And, certainly there's some people that are investing in vacation rentals and they're doing it just as a pure investment, and they're looking at it that way. And there are some that work. There are certainly some that work.
Sure, sure. Yeah. I think it's just like anything else in the space, right? I mean, there's people being successful at every little niche, but you have to put in the work, the grind, and you have to really understand the dynamics of that niche. And, I don't know a whole lot about short-term rentals or whatnot, but I'd imagine that there was a lot of people very excited to get through COVID because, that was one sector that was very much impacted. People couldn't travel. They couldn't, go spend time at some of these short-term rental places like they normally would have. And so, it was very, very much impacted by the situation we just got out of. So, but
Yeah.
yeah, yeah. But switching gears, you mentioned that you were seeking opportunities for passive income. You started out doing other businesses and whatnot, and then you landed into getting into the commercial real estate space, excuse me, and looking for co-GPs. And if anybody's a active investor or co-GP, you know that it's a lot of work. There's nothing passive about it. Tell us a little bit about your journey so far and what you've kind of discovered along your way.
Sure. So I started out buying my own apartment buildings up here in New England, and I followed a lot of advice from folks on podcasts like yours that said go find something that's working and copy it. So I did that. I went and found a working model in a town here in New England that has a pretty decent cap rate and has good property management available. And so I connected with the property managers and they helped me source some really good deals. So I've got those apartments that I'm now, operate. I've improved them, I've added some value, raised some rents, and are operating them profitably, executing the business plan. And at some point, that only goes so far on your own. And then you need to start thinking about how do you scale? How do you scale? And so in addition to that, I started looking into syndications, which of course many of your audience I know are well aware of. And I think like a lot of people, I got into syndications as a limited partner initially. And so as a limited partner, you put in the money, you get a front row seat to the show, but you're not actively running the deal. To your point, it's a lot of work to be a general partner, to run the deals and to source them and run them. And so I started off as a limited partner and I got some great mentors along the way. And now moving into the general partnership, I've got a deal underway right now that will be for 34 units, and it really looks good. So that's in process. And then also I'm working on some hotel conversions to microhousing with another investor group. So that's going to be a lot of fun as well.
Awesome. Yeah, I'm looking forward to diving into that, but I want to kind of go back and really highlight this. So how many passive deals did you participate in before starting to focus more on the active role as a co-GP?
Yeah, so I only invested in 2, and I did that mainly because my goal is to get to the general partnership, and that was my goal at the time. So I really just wanted to invest in the deals basically to get the front row seat with the general partners that I wanted to get close to. I think like many people, I like to have a diversified set of investments. So I look at a whole portfolio from a personal perspective. I still invest in the stock market, and I still invest in mutual funds and bonds, and and then I invest in real estate, both directly as well as passively. So for me, I want to allocate as much of my capital as I can to my own deals going forward. So for me, it was 2, and it was about getting an in-depth look with those GPs.
And I think there's something to be said about that, Cody, right? Building that strong relationship as a passive investor so that you can eventually transition into a co-GP or GP spot. Because when you're getting in these relationships, right, they're long-term relationships. They're sort of like, 5-year marriages. And what better of a way to figure out if this is actually somebody that I want to do business with long-term by making a passive investment and kind of taking that backseat and seeing how they operate, how they communicate, how they handle their business.
Yeah, I was going to say the same thing, Brian, and because this is exactly our message, right? For there, a lot of people come in and think that you could spend so much time studying. You get into this overwhelming sense of what do they call it? I'm losing my train of thought now, just because I want to.
Analysis paralysis.
Thank you.
Paralysis,
Yes,
yeah,
yes,
there you
thank
go.
you. Analysis paralysis.
Yep.
But really, ultimately, where your biggest learning experiences are going to come from is taking action, right? And one of the best ways to do that is, like you said, partnering with somebody on a limited partnership and being involved, in the asset management calls, in the weekly calls or updates, and really partnering with the co-GP and learning what they're doing. So talk to us a little bit more about that, Michael. Give us some tips for those who may say, this is a pretty interesting way to get started. What are some things that you would recommend to a passive investor that's looking to use this as a route to learn how to become an active investor?
Yeah, so I would say, now you mentioned analysis paralysis, and I was there. My wife and I are both very analytical people. I was, an engineer, by trade, and my wife's a CFO. So we're very analytical, and I would say I passed on well more deals than I should have early on because I wanted all the numbers, and I wanted not just all the numbers. I wanted all the verification of the numbers and the verification of the verification of the numbers. So I was there for a while, and what I realized is that it's really as much about the people that you invest with, and making sure that they can navigate the change as it happens, right? Because the best laid numbers from day one are only as good as the general partnership team makes them work. So as I got comfortable with who I wanted to work with, I would say that was the number one thing that gave me confidence to move in and be a limited partner. And I still think that that's probably the most important thing to look at. Now, I think there's several things to look at when you're looking at a limited partnership. I actually built a short video series, 5-part video series called the Spire Simple Syndication System. And I can give you a link to that. It's on my website, spireinvestmentproperties.com /SSS. And I'm sorry, SSSS. Spire Simple Syndication System. So it's a 5-part series that talks about, from a limited partner's perspective, what you would look for in a general partnership. In a general partnership and in a deal that the sponsors are providing. And number one is the general partners, but we also look at markets and submarkets. We look at the returns and the splits and the different ways these general partnerships get organized with limited partners. And a few other factors as well. So ultimately, it's really evaluating everything from the partnership to the markets to the deals to the numbers to make sure that it's something that you get comfortable with.
Yeah, I appreciate that. We'll make sure to reference that in the show notes and share that with the listeners. And I think it's just an important topic to really discuss, because as you mentioned, I mean, you can analyze numbers all day. You could try to ask for as many due diligence items as you need all day, but eventually, ultimately, like you said, you're investing in the people, right? You're partnering with these people, and that's the most important part of this process. And there is a vetting process that needs to be done and conducted, right? Because not everybody may have the same alignment of interest as you. And as Brian mentioned earlier, these are long-term investments, 5-7 years, sometimes even longer. They're very, very difficult to get out after you're invested. It's not very liquid by any means. And so you really want to make sure that you're investing and partnering with the right people that have that same alignment that you do. So, but in those experiences, you've gone through 2 LPs now, you've really learned a lot from are these 2 same operators that you're invested with, or 2 separate operators?
2 separate ones. Yep.
Okay, perfect. So I think that's always unique too, is having a handful of people that you want to work with, because you diversify and you learn different strategies. But what principles or what takeaways did you learn from those experiences for you directly that has now allowed you to make you a better active investor?
Yeah, so I would say I've learned a couple different. I've obviously learned a lot probably from both of them, but some of the unique things. So one of the opportunities, I would say, hit some roadblocks. That then got exacerbated by COVID. So the particular opportunity was more of a Class C property, and it was actually 2 properties, and we had a lot of property management challenges. One of the things that I liked about the opportunity going in was that I knew the general partner had a track record in this market and was being successful, and I thought would have the property management well established. what happened is just as the deal closed, the property manager had changed a lot of their fee structures. And because of that, went with a different property manager. That didn't go very well. And in fact, then we moved to another one that didn't go very well. And so there was a lot of blind spots in managing the property, blind spots from a financial perspective, blind spots from an occupancy perspective, and economic occupancy perspective. So in some cases, it was even found as we eventually got to a good property manager, which took a while to get there as you give each one a shot. When we got to a good property manager, first thing they did is go walk the units. It turns out that some of it was not people not paying, they weren't living there anymore. And it's like, oh my God, we have units that we think people aren't paying, sending them notices, and it's empty. Like, this is crazy. So a good property manager will, be the world to a general partner. And so one of the things that I'll look for any deal I go into now is, do I have a boots on the ground team that I can trust? Right. So my strategy is to work with other general partners as co-GPs. And I look for co-GPs that have the boots on the ground, or at least a relationship with an established property manager that we trust. Because if you don't have that, it is, early on, I think it's easy to make a mistake. It's easy to take a market that, you don't know much about and make the numbers work and rely on a lot of industry data, CoStar data, broker information, et cetera, and make a mistake. There's just a lot to be said for the person who walks the streets every day, understands the neighborhood by neighborhood dynamics, understands that the comps on rents for certain areas, yes, that's a little bit higher, but it's higher because of XYZ, some extra level of service. It's actually got 10-foot ceilings, and that's really a lot nicer than the 8-foot you're looking at. Or actually, I had one scenario where the comp we were looking at, it was very low. It was low compared to the rest of the market. It was low compared to our property. Our property was right across the street. And I'm saying to myself, well, how do we expect to get the rents that we think we can get in this area if right across the street, they're not getting anywhere close to that? And it was through the due diligence of the boots on the ground that we realized the property is having a tremendous management challenge. It's in a southern state, and it gets hot, and they can't keep the HVAC working right. So it's constantly, air conditioning's going out, and their management's non-responsive. It goes days without being fixed. There's no communication. And so nobody wants to live there. Everybody's turning it over, and they just keep the rents low. And I guess that's the strategy of the owner of that property. Not one I would subscribe to, but do we use it as a comp? Sure, we used it as a comp because we want to be conservative, but at the same time, that boots on the ground knowledge made all the difference in understanding the true rents in the market and the value of the property. So that's one of the things I learned from one of the folks. And then I would just say on the other general partnership, it was an interesting deal in that it was really an almost Class A property. It's really new, relatively new. It was 15 years old, and was just a little bit tired. And so I really love the strategy of taking something that you can make great. I love this, good to great. I think there's a lot of opportunities in the Class C properties, but for me, I've got a technology background. I love great service. I think making things great is exciting. Making money is always good, but making things great and making money is exciting. So I love this strategy of taking things that are good, making them great. That's what we're doing with that property. And we're just upgrading the amenities, upgrading the pool, upgrading the interiors, really just making it into a Class A property.
Very, very cool, man. And that point you just made, I mean, the two go hand in hand, great service and overall revenue, right? And I think today's resident base expects a certain level of customer service and experience, right? And that will eventually translate into overall increase in your revenue, whether that be through rents or long-term leases, higher conversions. or retention rates. I mean, all of the above. And so I think you definitely have to provide that service. You have to give the residents, we've been talking about this a lot lately, Brian, right? Is that focusing on that resident experience? Because I feel like over the past decade, this idea of the value add strategy where you just go and you boost the NOI and you flip it and you make this great equity gain. I think we're kind of getting out of that and now entering more into a decade where it's going to be focused on really operating as the value add, right? That's going to be where the true value add is over the next decade. Because you're not dealing with, first generation value add deals anymore. They've all been turned and renovated 4 or 5 times before you got to it now. So,
and that goes back to Michael's first point with property management, Cody. If we're getting into the next cycle where the value add play is less cosmetic and more operational, it makes it even more important that you have that strong property manager, right? That property manager who has a track record in that market, who you've got a substantial relationship with, you've been vetting for a period of time, and that knows that market in and out, kind of like Michael said, and can implement that value add strategy, whether it's just better customer service, answering the phone more promptly, putting Nest thermostats in, all these little things that are sort of becoming the new value add. I think it's a great point that Michael made, that when you're vetting an opportunity as a passive investor or as a co-GP, asking that question not only is who are the lead sponsors, but who's on their team, right? Who's on the legal team? Who's on the property management side? Who's doing the construction? Because at the end of the day, you can have a great group of sponsors, the people running the deal, but if they choose the wrong vendor, then you can have some hiccups along the way. Maybe you're planning on paying distributions in 60 days or 90 days, and it ends up going 6 months because, the first property manager they choose out the gate doesn't do the job that they expect them to do because there wasn't enough of a vetting process, right? So I think there's definitely something to be said about vetting all the other vendors involved in a transaction as much as it is the sponsors.
Yeah, well said, for sure. I love that you guys have recognized, or at least your perspective is around the whole renovate the interiors, move the rents up. There's only so much of that you can do to a building, and then it becomes the services and building community. And so that's what I love about one of the opportunities I'm working with another partnership group around microhousing. And what we're doing there is we're looking at hotels in urban locations where 1 in 4 people that are traditionally renting an apartment would like to move into a smaller apartment for a little bit lower rent, but make sure it's really nice, highly curated, and has a community-based living set with conveniences and services around it. I call it the hotelification of apartments, right? So think about going to a hotel and the level of services that you get at a hotel. And that's great for a short term, but what if your apartment would be able to provide you all those services as well? And so that's what we're doing with that group is building hotel conversion to microhousing. And what we mean by microhousing, a lot of people have heard about co-living. And I would say microhousing is similar. However, with co-living, you would share a kitchen and a living room and those sort of things. And in our microhousing concept, we have fully self-contained apartments. So private bathroom, private kitchen, 5 appliances, in-suite laundry, living, sleeping quarters, but in a very small square footage. So where an apartment might be, and it depends on your town, but an apartment might be 900 or 1,000 square feet. These would be in the 250 to 450 square foot range, but done really well, fully self-contained with everything you need privately, and then hotel level amenities that are shared. So places to store your bicycle or do ride share, and dry cleaning services, dog parks, trash cleaning, recycling, all of those things, and all enabled through your tenant app. So you're paying your rent and you're paying for your services, you're scheduling your services right through your app. And it's almost like hotel living, but it's in your apartment, and it's at a price point that is, something less than traditional apartment rental in a downtown, highly desirable urban location.
Cody, this is something we've been talking about pretty substantially. I think the term we've heard and used in in our circle is resort style living, right? Resort style amenities. And I think we were just talking about value add, and that's really the next iteration of, how do we move the B plus to the A minus or the B minus to the B plus? And also there's something to be said about affordable housing in general, right? Everybody knows that there's a big problem nationally with affordability with living. And, I've lived here in Houston, Texas my whole life, and seeing where the rents have gone just in the last 3 to 5 years it's people are starting to get priced out of buying a home. And eventually it's going to start getting more expensive to even live in an apartment, right? So there's something to be said about providing a quality product and that has everything you need. Yeah, it's not 3,000 square feet, maybe like a house, but it has everything you need to get by. If you're a young professional or you're somebody, just getting started who needs just just a small space to live, and you have all of those luxury amenities outside, an office and a pool and your cleaner all on site. I think there's definitely something to be said about changing people's perception of what they actually need to live, right? And I think if you present them with a good value proposition, which is really what this is all about, is do they see value in this amenities and in this style of living? And I think there's definitely an opportunity there in the future.
Sure. Yeah, you're absolutely right, Brian. And this idea of this micro housing, co-living type of community is very, very interesting to me. Excuse me. And you're absolutely right, Brian. I think the focus on that experience, giving them the resort style comfort that people expect, I think is important. But this micro housing space, it's interesting because Michael, do you feel like this is something that is actually taking off more national wide? Do you think it's more local to your region? Tell us a little bit more about, what niche does this appeal to?
It's absolutely not just regional. And I think the best example of this out in the market right now that's doing it at some level of scale is a company called Common. And now that's not the company that I'm involved with, but if you look at Common Living, they are doing this at scale. I think they just did another acquisition. So they were around 7,000 units across the country in several major cities. I think it's significantly bigger based on the acquisition they recently did. So I do think it appeals widely geographically, and I think there's different target markets. So the way I'm thinking about it, the way our partnership group is thinking about it, is building communities. So the community needs to be targeted around a certain I don't know if demographic is the right term, but a certain type of person that's looking to be part of a community. So one of the communities is the kind of young urban professional, right? So it's the person who's probably in their 20s, out of school, professional job, wants to live in the city, and probably spends very little time in their actual apartment, but wants it to be nice and comfortable and have all those conveniences we talk about. So that young urban professional, I think, is probably the one of the best target markets for this type of living when you talk about doing it in downtown, highly desirable locations where, you mentioned affordable housing, and a lot of people think about affordable housing on the very low end of the scale in terms of the cheapest housing out there. And I look at it, and probably you do too, based on what you just described. It's about affordability for what you're providing. So based on the location, based on the type of, apartment and amenities and so forth, is it affordable for that? So even, people with really great jobs right out of college, they struggle to afford an apartment in the locations they want to live. I have a niece that's in that boat. She's a couple of years out of a good school, got a good job, and she's trying to live in downtown Boston. And when she starts looking at the rents, she's like, well, I guess I'd have to find a bunch of roommates and figure out how to make this work. And she doesn't have roommates in the area that are looking for places that are people she knows. So she's really, kind of not sure, do I go in and move in with somebody and share this intimate space with somebody I don't know? That works for some people, but she would be a perfect target market for this type of housing. I think there's other demographics too, and we've got caterings to different groups, but that's the one for the downtown locations that I think is really desirable.
Interesting. Yeah, I'm glad you mentioned that about the resident demographic, because it is a point to know. Obviously you want to know who your ideal residence going to be, whatever niche you're in. But if you're a father like I am of three, the micro living space may not be the best suited. That can get very, very small. But
Cody, I'm sorry to interrupt you. I want to give the listener some perspective. I was actually on Common's website while Michael was poking around, because I'm just curious. Like, when people say affordability, that's really subjective, right? So in San Francisco, you can get a co-living space for $950 a month. Okay. And in Seattle, they've got some on here. These are, it's a private studio, and it starts at $855 a month. And if our listeners have any sort of anchor on how much it costs to live in Seattle or San Francisco, it's not under $1,000 a month for an apartment. I guarantee you that.
Not even comparable. Yeah.
Yeah. I don't know the numbers, but I'm assuming this is probably close to 50-60% off of what it might cost to live in your own shared apartment. So this is a huge opportunity here to really bring down your cost of living if you're a young professional, getting started fresh out of college, and you feel comfortable with that style of living. So this is really cool.
Yeah.
Yeah, and it's great from a landlord perspective. It may be obvious, but we've run some numbers around different places. One of them was in Seattle, Washington, and rent per square foot on a conventional apartment could be $4.70. Rent per square foot on a micro unit, because of the density you can create, can be $6.25.
Oh, wow.
So I mean, the opportunity is great, I think, on both sides, as the landlord and as the tenant, because it's a product that works for the tenant, and it's a density that makes the numbers more compelling for the landlord.
So, Michael, how do you model this out in your underwriting, right? I mean, when you look at, let's say you're going to buy a hotel and you're going to do these conversions, how are you modeling this out to put together whatever pro forma to present to both your lenders, your investors? What's the concept behind, okay, I could take this one footprint and shove 2 or 3 units in it?
Yeah, so it's not magic, right? It's very much like underwriting of any other multifamily, but I think the level of complexity on it comes from the development work that it takes to figure out what you can do with the building. That's where the creativity, the architecture, and that's why I love being part of the group I'm part of that's doing this, is that's what the rest of the GPs bring to the table. And so we'll take a building, for instance, we have one right now we're looking at Chicago, and it was a former hotel. It's currently vacant due to COVID and turnover, and the units in this case were very well positioned on most floors. They're about the right square footage. They've already got a private bath, and adding in the kitchen area, and we essentially take it down to the walls, or even below to the studs, if so to speak, and rebuild out each of the units. So that's the hardest part in my mind, is in terms of underwriting, is figure out what it's going to take to do it. What is the design process? And in some cases where we are taking a situation where we have to maybe combine some rooms together, or we need to split some apart. So it's as much a development opportunity as it is, kind of a rehab. It's more than a rehab, right? I mean, we're taking something that was a hotel and turning it into a microhousing unit. It's not, unless it was a Residence Inn or something that already had all the pieces there, it is a conversion. So partnering with a really good construction company, these are, $5, $10, $15 million builds. So this isn't, go find your Joe Schmo construction company down the street. This is people who are putting up large buildings that do it really well, do it professionally. They know how to estimate it. And so having them as part of the team, we talked about property management. Yeah, that's part of it. When you're doing these types of conversions, your construction company is as important, making sure that they can really estimate it well, that you can put that into your underwriting. And then the actual mechanics of the underwriting is just like any other multifamily, in terms of figuring out what your market rents can be and how you comp them, and so forth. And then you get to plan in your construction costs and timeline and lease up. That can take a while. There's a long way to revenue when you start with an empty building that you got to reconstruct.
Michael, and I'm curious, from the underwriting standpoint, is this a traditional sort of what our listeners are used to, syndication model, where you underwrite the property, you put it under contract, and you go raise capital from limited partners, people that are interested in passive investing with some sort of, let's say, 3, 5, 7-year hold? Or are you guys modeling this out a little bit differently, considering it's a sort of I'll call it a unique asset class, and a little bit more of what we would call like a heavy lift? These things aren't getting done in 6 months. Or is it more like new development where you're essentially holding capital for, let's say, 2 years, and then getting all their investors are getting their money back?
Yeah, so we're actually looking at some of those as well, some ground up development. In general, it's about the same. Yes, we're looking 5, 7-year holds, ideally around our underwriting. Sometimes less if it's kind of the build, lease up, and then turn it,
Flip it, yeah.
right? Flip it, right? But 5 to 7-year holds is generally what we write to. And as far as the traditional syndication model, you get it under contract, raise the capital, so forth. It is like that. I guess say we are a bit challenged in that some of these hotels are getting scooped up on all cash offers, and sellers see a syndication sometimes as a level of uncertainty. And so we've actually lost a hotel where we were the highest bidder because we had the syndication model as how we're going to raise capital versus really, a large fund that already had the money and could do it as an all cash offer. So one of the things that I'm doing is building relationships with some of the folks that have that kind of capital, $10-20 million, that can allow us to do all cash offers. But we wouldn't actually do an all cash deal, but we want to be able to do the all cash offers.
For sure.
Sounds
and
awfully
then syndicate.
Sounds awfully familiar, right, Brian?
Yeah. Oh yeah, we see that all the time.
We've lost out on several opportunities as of late because we're going with the syndicated model, raising capital, and then you have another competing buyer that comes in that has that
1031 money,
equity in hand, equity already in hand, and it's a no-brainer for the seller. So it is an interesting dynamic. But hey, going back to you mentioned these conversions and the importance of identifying the right construction team and whatnot. And it brings up a very, very good point, because this is not for the faint of heart when you're talking about doing these extensive scale type of renovations. We've looked at some conversions ourselves briefly, I think last year, very similar to what you just mentioned. Right. I mean, the hotel sector was absolutely decimated. There was many hotel opportunities that came about for really, just pennies on the dollar compared to, multifamily, for example. So we looked at that as a strategy of converting some of those, but it is very, very cost intensive, right? There is a serious amount of capital injection that needs to be going into these CapEx projects when you're renovating. Do you find that there is an availability of either construction teams or maybe even architect designers that have this specialty?
So yes, they absolutely exist. They're probably very busy, and most of them are going to be looking to be part of the team and participate in the upside versus just doing the construction. So and it's a lot to you mentioned capital infusion, but really there's a lot of investment before you even get the deal. And so I've done a lot of underwriting of smaller multifamilies, 100 units, 150, and you kind of look at it and say, okay, if we're going to do some interior upgrades, it's this much for flooring, it's this much for cabinets, we got to stripe the parking lot, we got to put a roof. You can estimate it in a relatively short amount of time. When you're talking about really doing ground up development or significant redevelopment like these projects, the amount of time it takes to architect what you're going to do and figure out the cost of it, there's a lot of investment up front. And unless you're willing to come out of pocket with significant money to pay people to do that, it's really about building that partnership team and making sure that you've got all those skills on your team and that everybody's got skin in the game and everybody's got opportunity to do well with it. And I think, to me, that's the secret sauce of this general partnership is we've got the team now together that covers all that. We're all making investments, and we're all going to be able to participate. And most importantly, our investors are going to be able to participate, because these are not deals that every every other syndicator is, out after. These are, deals that are harder, bigger, and the competition, although still very stiff, is it's just it's a different level, and because of that different level of risk, there's a different level of reward on it. So for the investors that are looking for some great opportunities and willing to take a little bit more risk through the development process, it's a great opportunity for them too.
Yeah, that's a very timely, topic and point to make, because I do agree with you that right now, with the competitive landscape across all of commercial real estate, multifamily in particular, it is getting harder and harder for the newer investor to break into the space. And there's so many more barriers to entry now than even prior to COVID. And so, looking at unique strategies or alternative type of strategies to find your way in is great. But like you mentioned, it's very, very important to make sure you're aligning with somebody who has that experience or has that understanding of this niche. So that way you can avoid making some very, very costly mistakes. So tell us a little bit more. I know you said you have a general partnership deal that you're on now, 34 unit, if I'm not mistaken. Tell us a little bit more about your opportunity that you have available now.
Actually, so I guess we're still in a capital raise on it. So I think I shouldn't probably get into too many details. It's probably going to be a 503B. And so I just won't get into too many details, but it's a lot like many syndications that you see out there with, value add strategy and some decent returns for LPs.
Awesome, man. Awesome. Well, interested to see that one come to fruition and cross the finish line. And again, really interesting topic here when you talk about these micro living spaces. I don't know that we've seen, I don't know, Brian, we haven't seen too many of those down here in the South yet, right? In Houston in particular.
Not yet, man, but I think they're definitely coming. Like I mentioned earlier, with the cost of living rising, everybody thinks of Texas and thinks of affordability right now, but there's so many migrants, there's so many people moving here. I think in our lifetime, Cody, we're going to see the affordability drop. And I don't know if it's ever going to be unaffordable, but I think a product like this is definitely going to be attractive, even if not for affordability, just to the generations up and coming. We talk about the Gen Y, the Gen X and all that. And, I'm going through the Common website or whatever, and some of these amenities, I'm like, man, I want to live here. They clean your room once a week, your co-living space. There's free Wi-Fi. They stock all the kitchens. They all come fully furnished with washers and dryers. Like, where do I sign up? So I think stuff like this is going to be really attractive to our convenience space, sort of instant gratification society that we all live in now. The idea of, going to work and coming home and everything's back in its home and somebody cleans your place. If you don't like your unit, you can just click a few buttons on the app and transfer rooms. There's a bunch of really cool stuff about this. I think a lot of people that are, like people like your son, Cody, that are young, they're going to love this stuff as they get older.
Yeah, it's compelling from a tenant perspective, and if it wasn't, nobody would be talking about it, right? So it's compelling from a tenant perspective. I think where the landlord side of it, it's a bit of a leap of faith, because nobody's proven if you gave free Wi-Fi, how much increased rent could you get? If you had electronic door locks, how much increased rent could you get, right? But where I see the opportunity for really solid business cases on the landlord side is around utility expenditures. So everything from smart thermostats, occupancy sensors, the ability to track usage of your common spaces and which amenities are getting used, which ones are not. There's a whole series of sensors, this whole Internet of Things technology people talk about, which is really just basically, things monitoring stuff, giving you data so you can make smart decisions, or that a computer can make smart decisions for you. Things like monitoring water usage, water temperature, and making sure that those are adjusted appropriately. All of those things, solar panels, you taking advantage of real estate that maybe you didn't think of, whether it's your roof or covered parking or things like that, where you can drive energy savings and government credits out of solar. All of those things. Some of the biggest costs, as you guys know, around operating multifamily is in the utilities. And a lot of people say, well, I just do RUBS, or, it's tenant paid. What do I care as the landlord? Well, that's money your tenants are paying. And although it's sometimes hard for them to connect the dots when they move from one apartment to another and they get a different bill on their utilities, it becomes obvious to them which money's going out. So can you drive a little more rent if you can prove out what the utilities look like, that, or your RUBS is lower or what have you? I mean, there's a lot of opportunity on utility savings for the landlord. And although tenants may not necessarily see or feel it, they should. We look at it as that's now funding all those amenities that they want, that maybe it's a little bit softer link to revenue on it. So I think there's a huge opportunity there. Plus, it's just the right thing to do, right? I mean, we got to say, I live in a coastal city. We have sea level rise, and it's a real thing. I see it around our town. And so doing the right thing for the environment just makes sense as well.
Sure, absolutely. Yeah, I think it goes back to what we were talking about earlier, right? Where it's efficiency through better operations, and I think that's going to translate into overall revenue when the residents are happy and enjoy living where they live. So, but Mike, been a great conversation, man. I really appreciate this introduction into the micro living space and these conversions. Really excited to learn more. I think we could continue to go down this path and really digest a lot more of this topics that you brought up, but we're getting near the end of our time. So, but before we go, we have 4 more questions for you, and then we'll wrap up. So,
all right.
One thing we like to ask everybody is, what do you like to do for your continued education to further your own investing?
I'm a learn by doing kind of person. So it may not be a popular answer, but I'm more about doing something. And even if I do it at a smaller scale, I do it to learn it, and that's okay. So of course, I do a lot of podcasts and those sort of things. But for me, I'm a problem solver. I've been doing my whole life. I'm a project manager. And so getting in, doing, figuring it out, I learn a whole lot by doing that. So
can't be taking action. That's the best way to learn.
Taking action.
Exactly.
Absolutely. What have been some of the lasting lessons you've learned along your way, Michael?
Keep going. So what do I mean by that? It's just nothing's easy. There's always hurdles, and there's always answers to the hurdles. So it's about keeping going, finding solutions, talking to other people, getting yourself some new ideas, and find a new path. And so for me, I think the old word I used to hear is stick-to-itiveness. I haven't heard that word in a long time, but I'd say that's ingrained in me. Get it done, figure it out.
Love that, man. It's a great remark, and it's so true, because I think that separates those who are successful and those who are not, right? Is they hang in there just long enough to break through those challenges, and you're a problem solver as a business owner. That's what you do. So any words of advice you'd give to our listeners to help them improve their businesses?
So I guess I would say, to me, this is a relationship business. So figuring out who fits your personality, who you can add value to, and who you can get value from, and go deep on those relationships. And as you do that, you're going to learn a lot, and you're going to accomplish a lot, because this game is too hard for one person to take on alone, I think. Maybe there's some people that do it, but I think it's about teams, it's about relationships, and so I would say find the right people. That'd be my advice.
100%
Absolutely agree with that. Yeah. Great advice. All right, Michael, tell listeners how they can learn more about you and get connected with you.
Yes. So the best way would be through my website, spireinvestmentproperties.com. I have 2 free giveaways. Once I mentioned earlier is the Spire Simple Syndication System. You can grab that there, as well as my ebook, which is The Insider Secrets to Real Estate Investing to Live Life on Your Own Terms. Both are available through the website, and you can obviously email me as well at michael@spireinvestmentproperties.com. Excellent.
Well, Michael, great conversation again. Appreciate your time. And thank you so much for tuning in with us today.
Yeah, thanks for joining us, Michael.
Great. Thank you, Brian. Thank you, Cody. Had a good day.